Today we're going to talk about a new type of adjusting entry. We've already covered deferrals, where we receive or pay the cash first before we recognize the revenue or expense later. So in other words, the cash comes before recognition of the revenue or expense. With our new type of adjusting entry called accruals, the cash comes after recognition of the revenue or expense. So for example, with accrued revenues, these are revenues that have been earned and therefore will be recognized even though cash has not yet been received. And accrued expenses are expenses that have been incurred and therefore will be recognized even though no cash has been paid. So for example, let's say that your company loans $1,000 to another company on July 1 and is charging 12% interest. The note and interest will be repaid in 1 year. So when that loan is made initially, the company loaning the money will debit notes receivable for $1,000 and credit cash for $1,000. Now let's say that financial statements are going to be prepared on December 31. We need to accrue the interest revenue that has been earned since we loaned the money on July 1 and interest has been accruing on that note, which we have earned, but we're not going to actually get that interest until the note is repaid next year. So we need to prepare an entry to accrue the revenue that we've earned, but we have not yet received. So the entry will be a debit to interest receivable and a credit to interest revenue. And how we calculate the amount is we take the $1,000 principal balance, which was the original amount that was lent to the other company. We will multiply by 12%, which is the annual rate of interest, and that gives us $120 for a year's worth of interest. Then the easiest way to make this calculation is to divide the annual amount of interest by 12 months to get to the monthly amount of interest. Then, since 6 months have gone by since the money was lent, we will multiply the $10 in monthly interest by 6 months to get the total amount of interest that has been earned so far this year, or $60. Now the hardest entry is the one that we need to make on June 30th of the following year, when that loan plus the interest is repaid to our company. So our company will receive a total amount of cash of $1,120. So our company will be repaid the $1,000 principal plus $120 in total interest, which is the full year's worth of interest. Now remember, we had already recorded $60 of interest in the previous year when we prepared our accrued revenue adjusting entry. And so now we get to remove that receivable from the books because now that the company is paying us the full amount of interest, it no longer owes us the interest receivable. We also need to recognize the other $60 in interest revenue that is accrued from January 1 to June 30th of this next year. And then finally, we will credit notes receivable to remove that from the books as well, since the loan is being paid in full. Here's another example of an accrued revenue. Let's say that we are a gas company and we bill customers on the last day of each month. However, the bill is not due until the 10th of the following month. Well, when those customers are billed on the last day of the month, we will debit accounts receivable and credit natural gas revenue. And the reason is we have performed the service of providing the natural gas to our customers. So we have earned that revenue, and therefore we have the right to recognize it and the corresponding accounts receivable. And when we do get the cash later on the 10th of the following month, at that point we will debit cash and credit accounts receivable to remove it from our books. So the first entry, what we're doing is accruing the revenue that we've earned prior to the actual receipt of cash in the following month. With accrued expenses, an expense has been incurred, but no cash has yet been paid. So let's say, for example, on December 31, that our company's employees have earned $1,000 in wages, but they will not be paid until the next week. We need to accrue the expense because our employees have earned these wages. So I have debited salaries expense for $1,000 and credited salaries payable. I also could have debited wages expense or salaries and wages expense. Here's another example. Let's say our company receives a $400 telephone bill for the month of June, and that bill is not due until July 10th. We need to accrue and recognize that expense in the period in which it was incurred by debiting utilities expense and crediting utilities payable. Just like with all adjusting entries, they will always impact at least one income statement account and one balance sheet account. And here you see utilities expense, our income statement account, and utilities payable, our balance sheet account.